Yeah, hi everyone. Thanks again for coming out, especially with the rain. So I'd like to introduce our two Pauls, our guests for the evening. So we have Paul Johnson and Paul Sonkin, and they've recently published Pitch the Perfect Investment, which we thought would be a great way to start off the school year, given that everyone is training for interviews and upcoming stock pitch competitions. So they will speak for about 30 to 40 minutes in a lecture-based style, and then we're going to open it up to Q&A. So we'll take questions for as long as you guys have questions, and then they did also bring some books down. The books really only just came out within the last week, so it's still limited inventory run, so if you want to get them as soon as possible, tonight is a great time to purchase them. So thank you again for coming out, and I'll turn it over to the Pauls.
Thank you. Well, we certainly, I'm going to speak for most of the first part of the presentation and hand it over to Paul. We certainly appreciate the opportunity to come speak to you at Stern. Paul and I, if you look at our bio, spent a lot of time up at Columbia, and we've always thought that what you guys do down here is very parallel and very powerful, and have an opportunity to come and actually get to know the community a bit is a real treat for us. So thank you for having us in.
I actually applied to Stern and I didn't get in.
I guess now you're in. Just never leave. And you'll be about
So I wanted to come here.
Paul and I have been working on this book for almost 4 years. We started 4 years ago in October, and we were at a Columbia event. And after the event, Paul was hanging out. And I was trying to talk to a good friend of mine, and Paul wouldn't leave and just kept hanging around. Paul is a former student of mine. He was a student of mine in '94 and '95 for 2 classes, and we've been friends ever since. He was my TA for a while. We did teaching for a while, and so at the end of this conference, I said, "What's up?" And he said, "I'm writing a book." And I said, "I always wanted to write a book, but it looks like a lot of work." And he said, no, it's going to be fun. And I said, good luck. And we got talking, and we were writing the same book. Or the book I wanted to write was almost identical to the book he wanted to write, except it was like the mirror image. So he was going to write a book that did this, I was going to write a book that did this, and they were mirror images of each other. And the name of his book was to be called The Perfect Pitch. And I always wanted to write a book called The Perfect Investment. True story. And by the end of the day, a few emails back and forth, and we've known each other at that point we now want to know each other for 22 years now. We've known each other for almost 20 years. By the end of the day, we were writing a book called Pitch the Perfect Investment. And so I started writing a book. I think if we both realized it was going to take us 4 years, we wouldn't have done it. That I could promise you. Last year was difficult. All right, we wrote the book for you. Not only you, but for you conceptually. 20 to 30-year-olds, business school undergrad or grad, that have a real passion for going into the investment management business, mostly on the analytical side and ultimately on the portfolio management side. There is no book out there, and there's particularly no book out there on pitching, and we think that pitching is a critical part of this. And frankly, when I started working with Paul, I probably didn't put that much emphasis on pitching. He brought that and continued to say that the architecture, really the backbone of any recommendation, is the pitch. And his argument is that if you can't get the pitch right, you haven't done the necessary work. And when he first told me that, I was like, I'm not so convinced. 4 years later, I'm absolutely convinced that the architecture of any recommendation into the stock market is in fact a pitch. And I will argue that every interview is effectively a pitch. We were at an event last week, and somebody got up and told the story that actually every meeting with anybody on Wall Street, even if it's an informational meeting, turns into a pitch. So even if you're going to meet with somebody, you want to ask them some questions, and you just want to get their career advice, maybe they're a friend of a friend or somebody you know in the business, it will inevitably turn into a pitch. Every interview will be a pitch. The portfolio manager may ask you a couple of questions up front. How is it at Stern? They may talk about where you're from originally, maybe some interest that you have, but that's just to warm you up. And before you know it, they're just chomping at the bit, and they'll say literally, what's your best idea? What do you have for me? What can you show me your work? And it is a pitch. So Paul and I have been very passionately trying to get this book done because we feel it's an excellent guide for people in your position to think about that pitch, whether you're in an interview or an informational meeting, a student-run investment club where you're doing pitches, or ultimately when you get a job on the street and you have to do this job. One of the quotes I think we have in the line is that on Wall Street there is no training, it's baptism by fire, and we were talking about Diana before, and she said, yes, it's baptism by fire, and we're trying to see if we can accelerate that. All right, so that's the quick background. Tonight, we're going to run through about a half an hour formal conversation. The book is almost 500 pages long. It's dense, as you will see as you read through it. We will not do it justice tonight. It would be almost impossible to do it, even if we spent hours speaking. We'll try to give you an overview of it, and we're going to focus mostly on the pitch, even though there are big chunks of the book that are leading up to the pitch, and you need to understand those parts to actually do an effective pitch. So we will get you set up. We've been asked at Columbia, we did this kind of discussion at Columbia, they've asked us to come back and do some seminars. We're scheduled to do 8 hours of seminars in the fall, and we probably won't get through all the pitching stuff. So it is dense, it's important, but we think tonight we'd like to give you kind of an overview of the way we think about it. But we will just touch on the book, give you a little bit of flavor. You won't be masters pitchers when you leave here, but you'll have a very good sense of the way you want to think about it. Okay? Good expectation. How'd I do?
Good.
Good. So we go next slide.
Space bar?
Down. Oh, look at
Space
that.
bar.
All right, if you're going to go pitch a stock, recommend a stock, or buy a stock if you're a portfolio manager. Pitch a stock if you're the analyst, recommend a stock. At the end of the day, you're arguing that this stock is mispriced. Either the implied return is greater than the risk associated with owning it, or the stock trades below some sort of target price or intrinsic value. So we structured the book in a way that the first three, if you will, the first 4 chapters, are how to think about that value, that fundamental value of the company. And we build it up through 4 chapters. The other side of the equation is the price in the market. So if something's mispriced, that means the price and value are not the same thing. Price and opportunity are not the same thing. So we then use the next 3 chapters to build up how you should think about how prices are set in the market. Those are fundamental chapters in the book, and they help set up the notion of the recommendation. We then talk about 2 very important ancillary chapters, or topics. One is how would you add value in research to determine the value of the underlying asset, determine the mispricing. We then talk about risk, which we think is a separate topic that often gets commingled. We've separated it out. Once you have those pieces down, price, value, and risk, you're then ready for your pitch. So you'll see as you look at the book, there's a lot of material setting that all up. We felt that that was very important because if you don't understand the fundamental components, you're not going to have the key aspects of the pitch. We then turn to the pitch. Tonight's presentation is going to focus mostly on the pitch, although we will touch on a little bit of that as well. All right? Go ahead. What's the goal? What's the accomplishment? What are you trying to accomplish? Whether you're in that interview, trying to get the job, or when you have that job and you're trying to get the portfolio manager to follow your advice, the goal in the pitch is really simple. That is to get the portfolio manager, it's almost always that's your audience, the portfolio manager to want to leave the meeting, clear their desk, clear their calendar of everything, so they can start working on it. Because great ideas are somewhat rare in the stock market. Your job in the pitch is to get them so excited that this is one of those ideas where they rush back, clear their desk, start working on it. Because they don't, their fear is to miss it. And we want to show you how we think you need to think about it to achieve that goal. All right, as we said, we're going to start with the pitch and then we'll work backwards a bit. The anatomy of a pitch, and this is we frame the book this way, is there are 3 key elements that you have to get right. First is the content. The first is the security selection, which is what are you going to pitch? And it's more than just a search algorithm, as we'll show you in a minute. We'll walk through it. Once you have a security to pitch, you then have the content of your pitch, how you're going to structure the information to present it in a way that gets the portfolio manager comfortable with the recommendation such that they'll act on it. And then the final is the actual delivery of it. And in that, we've taken a slightly different angle, as opposed to talk about what the PowerPoint should look like and the color scheme, which there are a lot of books. We really talk about the interaction of the analyst with the portfolio manager. What's going on, both the stated conversation as well as the unstated conversation. We'll touch on those 3. All right, let's start with stock selection. The first one. All right, the example we have is a portfolio manager and an analyst. In the book, we use an example of buying a home. We use this example because a lot of people are very familiar with it, and it's sometimes easier to understand the subtleties of the exchange rather than with stocks, and then we show the parallel. So the quick story is the following. Portfolio manager, in his mind, says, I want a summer home, gives some sort of characteristics near the beach. Maybe it's fancy, has a tennis court, maybe has a pool. starts to describe what that is. He then turns around and articulates that to the analyst. In this case, it would be a real estate broker, but the analyst. And you can see in the depiction that he's doing a pretty good job of describing what he wants. The problem is what the analyst is hearing is, or what they've come up with in their mind, is a home that doesn't match. So first thing you've got to realize is that when you're pitching in this case is you have to understand what the audience wants. You have to understand what the portfolio manager wants, which forces us to start to think about how the portfolio manager goes about evaluating investment opportunities. And in particularly, what kind of criteria they're going to use in that decision process. As Paul will say, if you get an opportunity to chat with him, he'll say that if we have any insights in this book, it's because we reverse engineered the process. It wasn't as if we sat around for the last couple of years and we argued with each other to get to what we think should happen. We both have a lot of experience teaching. We both have managed money for a long period of time, and we have a bunch of former students and friends in the business. And whenever we had the opportunity, we asked them, how do you think about this? How do you go about this? And we just kept taking notes, and then we would come back and compare those notes. And in the process, we reverse engineered this. And what we think we've done is brought a way for you to think about what they're thinking about, even though some of them aren't great at articulating. Next slide. End of the day, we think that every process can be mapped to essentially 3 steps. I'm not going to go into a lot of detail tonight, but the 3 steps are this dissemination, it's the acquisition of information. It's observing information, it's doing research to get specific information, it's consuming information that's out there, both public and potentially non-public information. Once you have that, if you're a portfolio manager, once you have that information, you will then process that information with a model. We use that as a generic, but it's your way of thinking about it. That's very much influenced by your experience and your domain-specific knowledge, as well as the facts that you already have. So you think about a portfolio manager, they tend to be an expert in certain areas. They have experience in those markets. They have models that they've developed through years of training and practice, and both mistakes as well as successful. And it boils down to this notion of what they know as to be sort of facts and true, as well as an expertise, which is the relationships of those facts and the way they think about those facts. That boils up to the second step, which is the processing. The net result is they arrive at an estimate. In our model, we tend to think of an estimate of an intrinsic value. You can think of it in other ways, target prices, potentially opportunity, but they come up with an estimate. And then if there's an action to be had from this, they then take action, which is effectively trade, buy or sell. And it's that buying or selling which is the result of this process. So if you look at the portfolio managers, that's a generic model we use. We found very few portfolio managers that don't map to this, although very few of them would describe it. If you're in that interview, how do you think about it? They're not going to put this up. But this was years of Paul and I interviewing and talking and debating, and finally realized that it's this 3-step model. Okay. As a result of that process, every portfolio manager essentially has a set of criteria that they're looking for in the investment that they want to buy. And more experienced portfolio managers have more of these sets of criteria, and each one of the criteria tend to be very nuanced. A lot of experience, a lot of pattern matching, a lot of subtlety that they have to it. The criteria tends to fall in 2 broad buckets. One we'll call fundamental criteria, and the other one would be valuation criteria. You can start to play with the notion that you're talking about price to book, or price to revenues, or price to earnings, price to cash flow, EBITDA. Those tend to be valuation-oriented criteria. Whereas other criteria, the size of the company, the size of the market cap, whether it's a domestically oriented company, what industry, and those tend to be fundamental. So that's the 2 big buckets. We then slice and dice the criteria in a slightly different way, and the big one is quantitative information and qualitative information. Quantitative information is things you can measure. Market cap would be it. Valuation metrics, those are quantitative, fairly easy to describe. Generally easy for the portfolio manager to describe to you. They say, I only look at companies between $1 billion and $5 billion in market cap. That's an investment